There's really only one strategy when it comes to investing in the stock market that makes sense for 99% of people. And that strategy is to buy and hold and then never sell. Or if you do sell, make it like a once in a decade kind of thing. So you find a good stock, you're able to see that stock performing well over multiple years and decades. You buy into that stock and then you hold it and you never sell, and then we'll see what happens. So there's really fascinating data that just shows what happens if you were to buy, for example, the S&P 500, even at the peak, at every yearly peak for every year over the last 75 years. It's quite staggering. So 75 years. I'm going to put a chart on the screen in a second here, but let's say you invested $1,000, or let's just say your grandfather invested $1,000 into the S&P 500 on the worst possible day of that year, and they did that every year for the last 75 years. So $75,000, or let's say 76 years, including this year, so $76,000. Those 76,000 dollars worth of purchases would have grown to over $4 million, in particular $4,014,177 over that 76-year period. And just keep this in mind. This is something that gets lost in a lot of people. That doesn't account for dividends, and especially dividend reinvestment. So every stock that I have that has dividends, that provides me with dividends, I just reinvest that back, and I automatically do it on my account, and I just reinvest it back into the stock, and I buy more shares of that stock or ETF. And so that's one factor in this. The other factor is if you had simply dollar cost averaged rather than attempting to time the market, that would have grown to well over 5 million. The reinvesting of the dividends for your dividend stocks would have gotten to a point where potentially you'd be sitting on $10-20 million right now. And multiple variables to consider here. One, the S&P 500 was positive in 73% of those 76 years. There were 20 down years. So sure, there would have been times that your account would have gone down, but 56 positive years and 20 negative years, that provides a really solid rate of return. And that's only, this may sound crazy when I say only, but that's only a 9.5% annual return when you combine all those years together. And then the second variable, of course, like I already said, is if you chose to never sell. And I don't know how that sounds to some of you, buying something and never selling, but you've got to understand that there is a point. This doesn't account for the reinvestment of dividends. There is a point where that could just be your retirement account, is that you just live off of the dividends. You build your portfolio to such a level that instead of reinvesting at some point, you were able to just take the dividends, and that would be your income, and you could live off the dividends. And then if you have children, your children could inherit that portfolio and hopefully repeat the same thing and pass that on to their children. There are lots of different things that a lot of really fascinating things that if you get your portfolio up to a certain level, you can do some really fascinating things with that. And also, you got to think about the fact that there were 50% bear markets during this 75-year period, from 1973 to 74, from 2000 to 2002, and then the 2008 Great Financial Crisis. Those were all 50% drops. And so again, if you bought those peaks, I know a lot of people, if you bought a stock right now and it went down 50%, you'd be kicking yourself and you'd be really upset with yourself. But what tends to happen over time is that things go up, especially in their dollar valuation. If you've watched any of my content over the years, you know my perspective on the dollar, that it is a melting ice cube, and you have these things that are not only holding their value in measures of the dollar, but actually appreciating in value. Even some stocks that you would think. Now, Home Depot, Microsoft, those are two stocks. I mentioned them in a recent video. Those are two stocks that have provided for not phenomenal returns in comparison to the market. But there's other ones that I've looked at that have not provided nearly as good of returns, but have still done multiple X's in the last 20 years. Something like really boring, like Hormel Foods. If you look at the Hormel Foods chart, people are always going to need to eat food. Okay, that chart has outperformed the rate of inflation over the years. Toyota. I have a Toyota. My Toyota is very reliable. It's fantastic. I love it. But if you look at the Toyota chart, there's other stocks that have outperformed Toyota, but still, if you had invested in Toyota, let's not say 75 years ago, but if you invested in that 25 years ago and you just bought and held, you would have seen more significant returns in the stock market. So I've gone a lot of different directions here, but what you need to hear in this video is, especially if you've been following my crypto content, the crypto that unfortunately it's conditioned us to have a mindset that we need to see multiple X returns instantly. And I really wish that a lot of people would get out of that mindset and have a mindset of, I'm going to see really solid growth, especially with compounding interest over the years. I'm going to see really solid growth over the years that, if you fast forward a decade or 2 decades, would absolutely blow you away. That's the perspective that most people need to have.